wasn't that exciting? A little bit of a video on a Monday afternoon. Hello, everybody, and welcome to the first webinar of the Hansuke Financial Services Tax Conference 2023, entitled FTT Has Teeth. My name is Suzi Evans. I am an independent expert consultant supporting Hansuke today as your moderator, as a long experience and deep experience of stamp duties, FTTs, as they apply to the financial markets. Now, I have with me a curated panel of experts from across the industry, and rather than read out their impressive CVs, I'm going to let them introduce themselves. So, Sinthu, may I start with you?
Sure, of course. So my name is Sinthu Sivakumaran. I have over 15 years of financial services industry experience. I'm a UK qualified tax lawyer by background. I spent 8 years at Latham & Watkins, so in private practice. And then I joined JP Morgan's EMEA corporate tax team in the product advisory space, largely working for the corporate investment bank. I'm an executive director in that team and involved in various tax industry group discussions as well, including chairing the European Tax Working Group at ISDA. I should add, and I must add, that none of the views that I express here today are attributable to those organisations. They're purely my own. But hopefully that mix of legal, in-house and industry knowledge will bring some interesting insight and meaningfully contribute to the discussion today.
Thank you, Sinthu. Elodie, over to you.
Hi, everyone. I'm Elodie. I'm a reporter. I've been covering EU affairs since 2012. I started with a specialized media called Agence Europe, and that's where I started covering tax, including financial transaction tax, the proposal at EU level. Then I moved to Le Soir, a Belgian newspaper, and then in February 2022, I left to cover tax full-time with Tax Notes International. So it's been 10 years that I've been covering taxes, including financial transaction tax, which has been sometimes a frustrating experience, as finance minister were always trying to sell us all the statements rebranded as new, which show how difficult the negotiations were, but I guess we'll have the opportunity to talk about that.
Thank you, Elodie. And last but not least, Jürg.
Yes, thank you very much. Good afternoon. My name is Jürg Stalder. I'm a product manager at SIX Financial Information, and I'm looking after the regulatory propositions that SIX has in the marketplace. And that includes as well classification services with which we can basically identify which financial product is subject to FTT or indeed other international tax regulations. And I've had the pleasure to work in this position for the last 10 years. And so really also been part of the introduction of new FTT schemes as well. So very excited to be part of this panel this afternoon.
Thank you so much. Now, despite the marketing of this session, financial transaction taxes are not new. UK stamp duty has been around in some form since the Stamp Act of 1891. And there are, as we just saw in the video, over 25 governments that levy these taxes on listed equities that are issued in their jurisdiction. You will, I am sure, have heard of Irish stamp duty, French, Spanish, Italian financial transaction taxes, alongside those that are slightly further afield from EMEA, such as Hong Kong stamp duty, South African, Taiwanese and South Korean securities transaction taxes. Now, until about 10 years ago, these taxes were relatively misunderstood outside of their local market. They were often either ignored or, equally as risky for investor returns, paid unnecessarily by cross-border investors in a bid to not be at risk of non-compliance. However, with the increasing focus on tax transparency from both the regulators and savvy investors, and the increasing number of these regimes being introduced, with existing regimes subject to modification, transfer taxes are beginning to step into the limelight. Now, navigating this evolving landscape with relatively few experts in the complex financial services industry is hard. overlay that with what I call the big black cloud of the EU FTT that keeps appearing and then disappearing in a cyclical pattern, it leads to uncertainty and confusion at a time when already we know headcount is squeezed and regulatory responsibilities are at an all-time high. So before I go on to more of the buy side, the asset management custodian industry, which is where my expertise lies, Sinthu, can you please just give us a little bit of understanding of how a global investment bank, how do you see transfer taxes impacting similar organisations?
Yeah, sure, no worries, Suzi. So I would say at the outset, and I'm sure it's the case for you as well, Suzi, and all of us on this call, I mean, these taxes alone could keep me gainfully employed for a really long time. I'd say they feature in kind of day-to-day in 4 space pockets. The first, I would say, in mission or offering documents. So if we take offering documents as an example, the purpose is to ensure that clients are well informed of proposed and existing taxes to a market standard level. So the EU FTT, I would say, has done a bit of a dance. It's been in and out over the years, depending on the traction of the tax and the noise in the market at the time. So investors increasingly have the protection of regulation that means that they can't be over, and the idea is to have offering documents market standard level that will flag material risks to investors. It's not to inundate them with information that may potentially at some point in time be relevant. So that dance has always led to an interesting conversation, I would say, from counsel or with counsel. The second area that I see this is in relation to transactions. So on what basis is the FTT charged is a question that does come up, regardless of the fact that the taxes have existed over the world. We'll be looking to buy positions, and the question will become whether or not they are able to avail of an exemption, and that's fine. They can potentially avail of an exemption, but as responsible person for the tax, we will be looking at whether or not we have the correct representations and indemnities, and where there's a market standard form in relation to this, everything's quite easy. But where that doesn't exist, it can prove for some interesting discussions with counsel and with clients. The third space, I would say, is in relation to appropriate restructuring of flows, and I say appropriate restructuring on purpose. These are not tax-driven restructurings. The regulatory environment, the non-tax spaces have required how to do business and how appropriately to do business, and the interposition of an entity will necessarily lead to questions over whether or not there's an incremental tax cost. Can you use market making exemption? Can you use intraday netting? Is intragroup relief possible? And that is something that I will be looking at. It's really in relation to the new taxes. So this is the critical part, I think, of this discussion today. Holistically reviewing new and evolving taxes and their impact in relation to various products across the bank. The financial cost, has that been syndicated to the desk, to the business? Do we need to alert clients? How will in-scope ISINs be identified? Will we use a third-party service provider? Pretty topical right now, I would imagine. And really rinse and repeat the other considerations that I've just mentioned. Is there market making exemption or intermediary relief? Do we need to apply for that? How do we identify ourselves as accountable person for those that need to identify us? Do we sign up to something like the AFME indemnity protocol? Is there a need for potential advocacy? Are the rules clear? Then you may well have industry discussions. So it's the sort of thing that leads to a number of questions, internal questions, external questions, and certainly the tax personnel within the organizations will be at the forefront of a number of those fielding responsibilities. So certainly an interesting space post-Brexit with Polish stamp, Spanish FTT, Hungarian FTT, etc. So
And it is hard, isn't it? And that's not limited to just the capital markets and the investment banks. And I've got lots of things that I can talk about that I'm sure most people listening now can attest to. But how do you think organizations such as the investment banks manage global consistency in terms of educating internal teams, obtaining cross-business unit engagement, and forming an element of robust governance to best protect the bank, given that quite often it is the bank, the brokers, who are on the hook as the liable party? What's the hardest part?
So I would say that, you know, the bit that is hardest, so the process part is relatively easy because of all the working groups that can be run. The bit that is hardest would be, let's start with timeframes. So if you look at Spanish FTT, we had about a year to implement that. And actually, you know, that seemed like it was tight, but then you ended up with Hungarian FTT, which was even tighter than that. So, you know, I think for Hungarian FTT, we had non-resident brokers brought into the space in July 2022, with an effective date of 1st of August 2022. You know, that's incredibly difficult to mobilize process changes in such a short time frame. The second area I would say is where you have lack of clarity in the rules. So again, if I can, I will, you know, it's where folks are asking very simple about who is an in-scope broker, what constitutes a taxable acquisition of shares, and you know, in areas such as cash equities trading, which is relatively BAU for these organizations, you know, what is an order and what is a taxable order? Do we look at the client order? Do we look at the fund allocations? Do we look at, assuming this cash equities broker is following best execution practices, which I expect they would do we look at how they split that out? And those are questions that are, as I say, incredibly fundamental. And as the tax experts internally, you are expected to have the answers in relation to those. So having that lack of clarity, I would say, is not particularly helpful, although it does lead to some interesting conversations. The third bucket is really extensions into the unknown. So, you know, Hungarian FTT did bring in bonds, for example, into the space of a taxable ISIN, and that was unfamiliar to a lot of folks because, you know, these FTTs have really captured equities to date. So that is something that led to new discussions across organizations with fixed income desks that are now, you know, sort of scrambling.
Okay, so I think we losing Sinthu. I'm just going to pick up, I mean, the message seems clear. It is complicated and it is difficult when trying to ascertain the different business activities across a large investment bank, over the top of new taxes with new asset classes and new ways in which these taxes work. And there is very much a big focus on these taxes to tax the broker or the custodian where there is no broker involved, and the responsibility for compliance and reporting, withholding the tax, paying it to the local CSDs or the tax authorities sits very firmly on those intermediaries as opposed to the end purchaser. And that's where we see a difference with the issues that clients face between the capital markets and the banking side of the world versus the end investor, so the traditional funds or the family offices, the high net worth pension schemes. Their focus doesn't tend to be so much around classifying the data. We have people like Sinthu and also SIX who can help us do that. But it's really about cost management, and it's about identifying where the risk lies. This is typically something that is quite obvious when we're dealing with normal portfolio buys and rebalancing. But when we go off market, that's when things start to get a little bit more difficult, because we're talking about these taxes which were primarily designed for the exchange trades. And we're trying to apply that into a fund transition or another buy-side off-market transaction. So it's as complicated, but maybe with slightly different focus when you're looking at the end investors versus that of the banks, who have to deal with getting it right and classifying the data properly. And Jürg, that leads me nicely on to what you do and how you help your clients, because it certainly seems to be much more of an interest at the moment compared to say 10 years ago. How have you found your clients reacting to stamp duties, SDRT, the FTTs of the world?
Yeah, I think we at Six Financial Information, we actually have the easy task in this, in that our focus is just on the data side. So we see financial instruments, whether they're exchange traded or not, and we can develop rules to basically ascertain and then express whether there is an FTT eligibility. And the way we're doing this is really with having like a coherent methodology in place to assess this. Obviously, we're not doing this complete in isolation. We sit in part of working groups as well, where we make sure that like the practice we apply to these FTT classifications is in line with what the market does. Now, I wanted to come back with what you said about or what Sinthu was saying about some of the challenges with FTT. There really is a particular timing aspect to consider as well, since you know, the government lists can change on a daily basis, and as I'm sure many people on this webinar are familiar with, very often those authorities are late with the publication of their lists, and if they publish them, they don't necessarily assign an ISIN. So there you have like a real problem to ensure that already before that kind of year-end date, you can provide as a data vendor some sort of preliminary classification that helps the kind of sales side and brokers to prepare their systems then for the new year. So that has very much been also the focus of our FTT activities, you know, working with clients, with different industry groups, and providing preliminary files that actually say, look, there's been a corporate action or a status change, and that's affecting a particular financial instrument. So we see very much this provision of this service of preliminary classification as something we deliver on top of the pure data. The other thing you've hinted to is, you know, increasingly we see from the private banking and wealth management clientele, I'd say, actually just to look at any kind of tax-related charge to be a cost factor in an investment decision. So as such, we were, for example, well, we as data vendor were bombarded with a question such as, well, should Ferrari be eligible for Italian FTT? And actually, you know, you have to back this up as a data vendor if you think that is not the case. And so such cases can, beyond the pure transactional part of it, you know, can have an impact of if somebody, like on say a buy side perspective, just think, well, a Ferrari is a good investment, and maybe, you know, shouldn't be subject to a 0.3 or 0.2% charge. So what we're really seeing is FTT and stamp duty data coming from a purely compliance and you know, getting the calculation right, levied when it's appropriate, to really being part of actually the investment decision process. And this is coming, what we mainly see, as I said, in the kind of like wealth management and private banking space as well. And we had to go to the extent to also start actually calculating what a tax cost charge for a financial investment would be, and therefore, you know, FTT, if it applies, would be such a charge that we as a data vendor calculate as well.
And are you finding your, say, broker and custodian clients requiring that insight to flow straight through to their confirm notes so that the end investor can clearly articulate what is included in a management fee, for example, so that the more savvy investor can decide whether or not it is worth it, or if there is another way? I mean, it's no secret, you know, you want to invest in UK, you can go on swap. Are you finding more requirements from your clients for that granular detail now?
I'd say at this point, the tax cost charge that I mentioned is still predominantly seen from when you have an investment. It could be any investment, and there's income related to it, and you know, it's the kind of view is how much of an income I could have is actually diminished by a tax. So that's the bigger part. But when you go into kind of workflows where I would say maybe trading in and out of a particular FTT stock can have an accumulated effect. That's where we really see it. So it's both. I would say you have to kind of cater for the gist of the advisory use case where can you just give transparency into what tax charge and FTT charges to the moment to also like then when you just like assisting in an advisory decision can actually an advisor say, well, careful if you're trading in and out of FTT eligible instruments too often, that might have an accumulated tax charge.
Yeah, that's a really interesting point. I prefer just buying the Ferrari as opposed to the equity. It's much safer from an FTT perspective.
Apologies for the terrible internet. If there was anything else that you wanted to ask on the sell side investment bank perspective, very happy to try and answer that now, but the internet gods have given me internet back again.
Don't worry about it. I'm sure we will dip in when we've got another half an hour, but thank you. I'm glad to see you back here. No. Elodie, we've just been hearing about how it can be quite confusing and complicated and a bit of a drag, excuse the pun, having a patchwork of unilateral FTTs. And I always say that we have a good, bad and ugly scenario when it comes to these types of taxes. The good is that I can retire, they're all abolished and I can just fly off in a Ferrari. The bad, I think, is the EU FTT, and the ugly is more what we're heading towards, I think, but you're the expert on this bit in terms of current affairs, where we have a patchwork of unilateral taxes with different rates, different rules, different applications. So what's going on with the EU FTT? Why haven't we got one yet?
Yeah, so maybe I'll start with why don't we have it one yet? I think we have to recall first that the FTT was proposed for 28 member states when the UK was still part of it. And then they decided that it wouldn't work with 28 member states because we didn't have 28 countries in favor. So they had to go for what we call the enhanced cooperation. So basically we had 11 countries saying, we agree with the idea, so we are joining the project. But then you had everything to negotiate. And so some countries would join the project because they liked the project, didn't recognize the project when the negotiation was going on. So for example, countries were asking for a lot of exemptions. Italy, Belgium, for example, were afraid of the impact on their pension funds. And I remember one finance ministers meeting, it was a public session, and the German minister, Wolfgang Schäuble, he said, he compared the FTT to a Swiss cheese, and he said, it's okay that we have holes in the cheese, but if we only have holes, then we don't have cheese anymore. So that was a big issue, and that's an issue that that led Estonia to leave the enhanced cooperation. After that, we had Brexit, and so member states wanted to wait and see what would happen, what would the impact of Brexit be on a potential FTT, and then talks started again in 2019 with the French and German proposing to review the whole project and go from the French FTT, so only on shares, and copy-paste, basically, not completely copy-paste, but get inspiration from the French FTT. But that meant that the FTT that was supposed to raise 57 billion a year was only going to raise 3.44. Which also means that Slovakia and Slovenia, with the cost of introducing the FTT, would get, and I'm quoting actually from an impact assessment that the Commission made at that time, they would get zero revenues. So I mean, how do you keep them on board if it's more expensive to just introduce the FTT than the tax revenues that you would collect? So there were talks at some point that member states that were supposed to get more than 100 million from the FTT would give 20 million to Slovakia, Slovenia, but Spain opposed. then we also had Austria saying, oh, but we want to tax speculation. We don't want to tax only shares. We should go back to the initial project. And in the discussion, what was also telling was the lack of political guidance. So we had experts, technical experts, the tax attachés here in Brussels, negotiating without political guidance. So at some point, they just stopped, and no presidency, no member state said we should try and talk again, which leads me to the situation now. And I think to really understand the situation now, we have to remember what the initial purpose, political purpose of the FTT was. So it was after the financial crisis, and in 2010, member states said at EU leaders level, we should make sure that financial institutions make a fair share to pay for the financial crisis, to pay for the cost of bailing them out. But in the mean, so that was the initial purpose, political purpose, and there was a lot of public pressure in favor of this political purpose. But then the Commission came up with another idea, the EU Resolution Fund, and so banks are supposed to pay some sort of levy into a resolution fund. So, I mean, for that, we are covered. Banks are paying into a resolution fund. So in a way, that political purpose was already achieved. The issue came up again during the COVID crisis, because the EU had to borrow 800 billion euros to pay for its recovery plan. And I mean, we have one budget, but it's not, we might say that it's big, but considering the number of policies that we have to finance, we can say that it's big or it's small. But as of 2027, if I'm not mistaken, repayment of the loan will be 15 billion a year. So either member state foot the bill, or we finance less other policies, so less money for other envelopes, or we get new levies for the EU budget. So in that context came the idea of an FTT, and the members of the European Parliament wanted it. But member states were saying, oh, but today banks are helping, they're supporting the economy. So we don't want to punish them anymore for this crisis that we have, because they're not responsible. They were in 2008, but they're not today. But member states reluctantly agreed to ask the Commission, if needed, to come up with a proposal in 2024. But the Commission came up faster, and they actually made their proposal in June. And basically what the Commission said on an FTT is that the prospect of an agreement it's unlikely, so they don't think an FTT is a good candidate for an own resource. They like the idea of a tax on crypto better. They say that some member states have some sort of tax on this, but they don't define crypto assets the same way, the taxable event the same way. So there's a plethora of questions to settle before we can talk about the tax on crypto. So they say it might be a good candidate for the medium term. And in the summer, we've seen France, Germany, and Portugal saying we should talk about what we agreed in 2020, meaning maybe a non-resource base on an FTT. So we're wondering how this debate will evolve now. Nothing has, ever since the three ministers came up with this request during the summer, nothing has happened as far as I know. So yeah, that's where we are.
So it does seem like there's a lot of going forwards and then two steps back. And I know when the resolution was announced in May this year, there was a lot of excitement that this thing was actually going to happen by 2026. But obviously behind the scenes, there is more noise where there's more contest between each member state. And that's the interesting thing. I think the Swiss cheese analogy is perfect, because it does seem like every member state really is happy to have an FTT, a tax on equity transactions. They like the idea, but just as long as it aligns to their own priorities. So some will be very protective of their pension scheme industry. Some will be very protective of the market makers. Some will want to make sure that if they are administering and catching and paying away all of this tax, they want to get some sort of compensation for that, hence Slovenia, Slovakia. And I think I was speaking in Texas last month, it does seem that the thing that needs to happen to make this go forward is agreement, but that is very difficult when you have individual member states all wanting their own things. If Commission was to agree to all of them, as you say, there wouldn't be any revenue raised because it would be a tax regime full of exemptions, and that would simply be costly and unreasonable. So it does seem like the driver has changed. What is it that European Parliament ultimately wants, and why has it changed from the previous proposals? Could it impact the FTT that we do ultimately see? And I know we've been talking about the EU own resource package, but are there any other ideas out there that you can think of that might come to fruition?
Yes, so apart from the tax on crypto, members of the European Parliament also asked as a possible alternative to look at shares buyback. At some point earlier this year, there were a lot of share buybacks by companies. But the other thing that is really growing now, and there's public pressure, and public pressure is always needed for this kind of project, is windfall profits in banks. And there we can see that many member states are introducing it, sometimes backtracking on some aspects of it, like in Italy, for example. In Belgium, I think in Belgium, the debate is really interesting because basically what some political parties in Belgium are saying is that we have good rates with the ECB, the European Central Bank, and banks are benefiting from these good rates, notably the deposit rates, but interest rates on savings accounts are really low. So banks are not giving back to savers the good rates that they have, and so they make windfall profits, and so we should tax that to make sure that it would go back into public coffers. But in Belgium, I think it's pretty clear that if banks were to just raise their interest rates on savings account, the government wouldn't probably go for a tax. And it's not sure that they will go for it because there's no agreement in the government. But I think that maybe at some point when the Commission sees that member states are going these different ways, the Commission will say, oh, we risk fragmentation in the single market, so maybe we should have a chat about financial activities, and so maybe that could go anyway, I guess, but that could be a reason to have the debate again. And I mean, if you've seen, there's a renewed interest also at global level. I mean, we had a summit in Paris for climate finance, and I have to find that, but there was a statement at the end of that summit, and basically they were saying that the global community should look at ensuring that the financial sector is taxed in a fair manner. And there's also an op-ed with 70 economists calling for an FTT in the French newspaper Le Monde. But I guess these issues, if you have those kind of op-eds and the international community talking about it, I mean, it would be the best way for the EU to do something about it. If there's public pressure and global community on board, that's always easier. That's what Schaubler was always saying. It would be easier if we were to have it at the G20 level.
And in the meantime, I mean, we've already seen France, Spain, and Italy become impatient with a decision or any movement. And so they have introduced their own. And the irony is the dragging of the heels at EU level is providing evidence that these taxes do work on an individual basis. And I really wonder how long it will be until Portugal turns on its tax that it has in its box of tricks that it's drafted when Spain drafted theirs. We also have the UK redesigning their dual running stamp duty SDRT to create what might be called a UK FTT or a UK securities transaction tax. So I think in the interim of there being either mass movement through public pressure and international committees to prevent fragmentation within the single market, it may well be that we start to see more of these taxes. But Sinthu, from your perspective, what would be your greatest fear from a legal perspective if the EU FTT did come to play based on a previous suggestion of a low rate over equities on an issuance basis, for example, over a number of equity markets?
Oh, thanks, Suzi. I would say, I mean, as a recap, because I'm not sure how much I actually got through, I did just flag up 4 things as my kind of difficult challenges within the bank or similar organizations and in relation to these taxes. And there were number 1, time frame, number 2, lack of clarity, number 3, extensions into the unknown and having things like bonds included, and number 4, finding those advisors that can give you meaningful advice. Now, if I take your question now and think about, you know, whether or not I find any one of those more difficult or a bigger fear than the other, it would have to be the lead time, the time frame. So a low lead time would be my greatest fear, I think, in this particular context. I almost went for lack of clarity there, and you know, the thing is that with lead time, you can overcome lack of clarity, at least theoretically, right? You can get the advice. You can, you know, if you can't get the meaningful advice from advisors because it's all too grey, you can go to the authorities themselves, you can seek ruling, you can undertake advocacy via industry bodies. But you know, the time frame there really needs to be significant enough to mobilize internal change. For global organizations, you know, you need to be able to identify products. To Jürg's point, you know, you might need to engage with external providers to do so. You need to probably do a tech build internally to pick up the taxes. You know, compliance isn't optional for these organizations, and it's not optional for anyone. So the reality is that this could be a compliance nightmare without the lead time, because you're inefficiently putting into place manual processes, not because you're not complying. And I think from an authority perspective, it's also in their best interest that, you know, there is sufficient lead time so those questions can come to light in relation to the lack of clarity points ahead of time, so they're not fielding it whilst the tax is live. So yeah, I mean, I did try and cover all of the points within that, but I think the lead time really does capture my greatest fear.
Thank you. And I do wonder if we end up with some sort of faster initiative, but for FTTs, if those in power don't necessarily listen to those who have to deal with these things every day, where we end up with a patchwork. But that's just my view. Jürg, what's your thought? Where do you think you're going to be in 10 years' time in SIX Financial Solutions and your clients? Will we get an FTT at EU level? Do you think we're going to end up with more unilaterals? What are your thoughts?
Many questions,
all of
but
them,
I think
all at once.
I think if we're looking at a 10-year timeline, we just really have to look at the technology change as well in this. And here I'm talking about, like, you know, trading technology in the widest sense. Like, we're really moving into an environment where we have like instant settlement, and no longer kind of these, well, some of these processes that like are behind the actual regulatory insight to, okay, let's make some tax money there. So I really think that those legacy stamp duty and FTT schemes, they will over time be replaced by something. I don't see that like overall there's kind of like one model that would be rolled out. And it was, as mentioned before by Elodie as well, I really think that like now the focus has shifted to digital virtual assets. I mean, we're seeing that there is a chance that is seen with the, you know, to kind of move in step between the regulation part being MiCAR and then the tax part with being CAR. So maybe that will be, you know, the new world of digital assets will be a more will be a more an interesting field to have a consolidated approach as well across jurisdictions. I think, looking back, you know, the idea of using an FTT as a way to react to financial crises as well has in certain ways backfired a bit on the jurisdictions that have introduced it. In that, I mean, they maybe see that actually trading activity in those stocks, for example, affected has been reduced due to an FTT. So obviously we look that we can, as a data vendor, we can address these new tax requirements. We're familiar how this works, but I would say that like the technology change will be towards something that will be more akin to actually the reality of what's happening on the financial transactions.
And in a way, that might not be a good answer for the taxes that are currently in existence now, because it's unlikely they're going to be unwound. It's unlikely that, the French, the Spanish are going to say, oh, we've got a bigger, better version over here for crypto, let's get rid of that. They're just not going to do it. They'll just leave it. And actually, that might be even worse, because we still end up with the archaic, slightly clunky way of it operating. If they did overhaul it into the new world, I'm not even going to go into the blockchain side of things, and distributed ledgers, but if they did take some ownership and move it forwards with the times, we may end up with a tax that's more fit for purpose in today's modern world, as opposed to something that is currently, as you say, we've got different ways of paying, different rates, different exemptions. Cross-border, it's all a little bit more difficult. And Sinthu, I'm pretty sure I've heard your view as well. And Elodie, tell me, do you think that the EU FTT as we know it is going to happen, or do you continue to agree that it might change into a crypto world whilst retaining those that we currently have as a patchwork?
I mean, I think I agree with what Elodie was saying earlier in relation to the focus being elsewhere. So yeah, I don't think it's something that we can expect anytime soon. The focuses are elsewhere right now, and rightfully so, I imagine. This is a post-COVID recovery mode for many authorities, and if all of the jurisdictions are going to materially be uplifted in terms of revenue by the tax, then you can see that there might not be as much focus on this versus some other, particularly interesting and potentially more materially useful taxes. So, I'm perhaps overly pessimistic, but I do think we're just going to have a patchwork for some time before somebody has the bright idea, and it won't be bright necessarily because it's not novel, to go back to the EU FTT proposal and unify everything. But yeah, as I say, interested to hear what Elodie has to add to that.
Yeah, well, I was just thinking because, going back to my previous stories, impact assessment from back then, in the 2011 impact assessment, the Commission said that if taxation in one member state of financial transaction coexists with non-taxation in other member states, it would distort the proper functioning of the single market and would increase incentive for relocation of financial activity within the EU. So they say that if some have this tax and some don't, not only it's a fragmentation, but it also open loopholes. And they give the example of Sweden, which introduced such a tax in 1948, and yeah. And so I'm wondering if at some point, if member states see that there's some financial actors actually escape the tax, that they would try to have extraterritorial effect. And this was actually an issue in the discussion between member states. So since the 28 member states, 28 back then, were not negotiating an FTT, the Commission said we should have a residence principle. So we would tax based on like the tax would be due if any party to the transaction is established in one participating member state. But then non-participating member states were like, this is a breach of EU law. And the UK actually sued the enhanced cooperation in a way, but we never had the answer by the court, because the court said this is a draft directive and you cannot sue a draft directive. So we never knew if these extraterritorial effect of the negotiated at the time FTT would be in breach of EU law or not. So I mean, if these kind of issues arise, extraterritorial effect or loopholes, tax avoidance, this might also be a reason for the you to start the debate again, maybe on anti-avoidance measures, or I don't know, but so I think it will be interesting to see what are the effects of the national taxes that are being introduced. And I'm also wondering, because we've adopted DAC 8, the exchange of information on crypto this year, so member states will start receiving data. And I'm wondering also how this data and what member states will find in the data they received will feed the discussion on the tax on crypto. That might also be interesting.
Thank you so much. I'm very conscious of time. I don't know if we've got any questions. There are a few. So, okay, I will pick that one up. It's more of a reminder for tomorrow. Thank you, Jürg, Elodie and Sinthu. I'm really grateful. It's always a more balanced and rounded conversation when you don't just listen to somebody from one particular part of the markets. And it is really interesting listening to the political side and the technology provider side, and also obviously general counsel and how you manage it. What I do genuinely believe is we're not going to be seeing away with these current FTTs that are in the market now. They're there, they're staying there, they are raising money, even if it's not as much as the relevant markets wish for in the more recent FTTs. I also think that they're going to be subject to change. I think rates will go up as revenue needs to increase. I think exemptions will get harder. That is something that we have seen already. France increased their rate from 0.2 to 0.3% in 2017. Hong Kong have just introduced their new rate of 0.26 instead of 0.2 back in 21, I believe it was. So there is going to be a focus on these taxes, and whether or not the EU FTT comes to light on crypto or in any form, I don't think is going to impact this patchwork. So all I can say is to everybody who has dialed in, thank you. We hope you found today insightful. We hope you found it interesting having different voices from different sides of the market. And obviously, if you have any questions, please do not hesitate to reach out to any of us. Very happy to talk. I'm going to leave it then. Please do remember that there is another webinar tomorrow, Trace to Faster. So the other investment tax, this time on the withholding tax. Same time tomorrow, 2 to 3 p.m. And on that note, I wish you all an excellent Monday. Have a great day. Bye-bye.